The Fed has decided and the markets are reacting. Joining me now is Beth Ann Bovino. She is the U.S. Chief Economist at Standard & Poor's. Hi, Beth Ann.
Great to be here.
Thank you so much for joining us. So rates are left unchanged. No surprise there. The Fed did drop the word patient in its statement, which also should be no surprise either. What's the strategy behind the wording?
Well, I think the patience, if they left patience on there, that would have suggested that a June or September rate hike not in the cards. So removing that leaves those options available for the Fed. It also kind of gives them a little bit more wiggle room. They're dependent on the data, and so they don't want to really be stuck to a word.
And the Fed has been quite transparent. They've been telling investors for a long time a rate hike is happening this year. So do you think a June hike is now on the table? And once a trigger happens, is it going to be a steady increase every meeting?
We've been holding to a June rate hike since, well, last fall. Now, again, it always depends on the data, and we'll see what happens. We kind of wrote off this first quarter as kind of a weak quarter, largely because, well, if you looked out the window, you saw all that snow, a lot of economic activity didn't happen. But we still think the economy is strong enough and the jobs are there to get the Fed to move further.
And the markets are dreading going back to normal, right? Because it's been artificial maneuvering by the Fed, but it's worked, and other countries and regions are following the Fed's playbook. How is the U.S. tightening going to impact our stance in the global economy while Europe and Japan are now easing?
Well, I think it's also we'd call it a separation anxiety. We got used to it. It's been 10 years. I mean, it's been almost 10 years since we had an interest rate that was not near zero. People like to have that actually very, very cheap borrowing, but it's got to go away sometime. And they forget that the reason why it's going away is because the economy is getting stronger. We're strong enough to withstand it. We've now seen job gains. The last 12 months, we've had job gains around 265,000 jobs gained a month. And we're starting to see the change in terms of the types of jobs are improving. So we do expect to see wages increase, and I think that's why the Fed is expecting that and why they want to move.
And you mentioned those economic data figures, like the unemployment rate now dropping, but on a very microeconomic level, at kitchen tables across this country, personal economies haven't changed all that much for some people, but despite all of that, you're pretty positive that financial conditions in U.S. households are going to push consumer growth. Why are you so optimistic?
Well, we have started to see wages tick up, and there's a couple other factors that we look to see why we think they're going to go up higher even further this year. One thing you look at is the unemployment rate. The unemployment rate is now at 5.5%. Now, if you look into the details of that, there are a lot of people that left the jobs force, and that means some of them left because they couldn't get a job. That means that still there's a lot of sluggishness in the economy. But still, I mean, part of that though is that we did see a lot of people getting jobs. Another factor to take into consideration is the so-called quit rate, that sort of voluntary separation. That's now at near a 6-year high. That means that people are feeling, or workers are starting to feel like there's more bargaining power. They can quit this job, and they're happy they're going to be able to find something new.
Great, thanks so much for sharing your insight with us today. Beth Ann Bovino is the U.S. Chief Economist at Standard & Poor's, and for The Street, I'm Susanna Lee.